Schedule A taxes feel simple until the SALT cap shows up. If you itemize, you can deduct state and local income taxes or sales taxes, plus property taxes, but only if the tax was imposed on you and you actually paid it during the year. On the EA exam, watch for paid by someone else or not legally owed. Those facts quietly kill the deduction. Now the SALT cap. For 2025 through 2029, the combined deduction for state and local income, sales, and property taxes is capped at $40,000, or $20,000 if married filing separately, and there's a high-income phase-out. Starting in 2030, it reverts to $10,000 or $5,000 MFS. On the EA exam, they love asking which year uses which cap. Foreign taxes have a weird split. Foreign real estate taxes are not deductible on Schedule A anymore. TCJA eliminated that itemized deduction. But foreign income taxes are still deductible, and they're not subject to the SALT cap. Mechanically, state and local taxes go on Schedule A lines 5A through 5C, while foreign income tax shows up on line 6 as other taxes. Interest deductions are another favorite exam trap. Qualified home mortgage interest is deductible if the loan is secured by your main home or second home, and it's acquisition debt, meaning used to buy, build, or substantially improve the home. The general limit is interest on up to $750,000 of acquisition debt, or $375 MFS. But older loans can be grandfathered at $1 million if incurred on or before December 15, 2017. Investment interest expense is still deductible, even though most investment expenses were suspended under TCJA. Think margin interest on a loan used to buy taxable stocks or bonds. The catch: your deduction is limited to net investment income for the year. Anything over the limit doesn't disappear, it carries forward. On the EA exam, they'll hand you wages plus investment income and see if you incorrectly use AGI instead of net investment income. Finally, know what interest is flat out non-deductible. Personal interest like credit cards and car loans is out. Interest to buy or carry tax-exempt securities is also out. No double dipping. And if the taxpayer isn't legally obligated on the debt, the interest isn't theirs to deduct. When you see muni bonds in a question, your reflex should be, related interest is disallowed. Natalie and Derek are married filing jointly and itemize. They have these Schedule A items: $6,000 of Derek's employee business expenses, $7,000 of mortgage interest on acquisition debt with a $375,000 loan, $3,000 of real estate taxes, $3,000 of state income taxes, $1,000 of gambling winnings, and $8,000 of gambling losses. What total itemized deductions can they claim? Think about it. The correct choice given is $18,000. Here's how you should reason. Employee business expenses are miscellaneous itemized deductions and are not allowed under TCJA rules. Mortgage interest is fully deductible here at $7,000. SALT is real estate plus state income tax, so $6,000 under the cap. Gambling losses are only deductible up to winnings, so $1,000. The tempting wrong move is deducting the full $8,000 of gambling losses. Natalie has $4,000 of investment income and $50,000 of wages. She paid $1,500 of margin interest to buy stocks, $850 of credit card interest, $3,000 of personal auto loan interest, and $475 of interest on a loan used to invest in tax-exempt municipal bonds. How much of this interest can she deduct on Schedule A? Think about it. The answer is $1,500. Margin interest used to buy taxable stocks is investment interest, and it's limited to net investment income. She has $4,000 of investment income, so the full $1,500 is allowed. The tempting wrong answer is $1,975, because you might add the muni bond interest, but interest tied to tax-exempt income is disallowed. Credit card and personal auto loan interest are personal interest, also non-deductible.